PPI feeling hot, hot, hot. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Alex Steele. Market reaction, though, could have been worse.
Yeah, a lot worse.
It could have been a lot worse. We're kicking you off here to the closing bell right here in the U.S. Yes, the S&P is a little bit softer now, down by 0.3%, but we did hit a record high earlier in the session. So again, it could have been worse. Taking a look at the VIX, similar story, could have been worse. We also have about $1.3 trillion worth of options expiring today, so interesting to see how the VIX will settle out. And the Bloomberg Dollar Index flat right now. However, we are looking at 7 straight weeks up for the Bloomberg Dollar Index. We haven't seen that kind of streak since September, and the 10-year yield up by about 6 basis points. The front end of the curve up a little bit more, but again, could have been worse, Romaine.
Yeah, could have been worse. I feel like a theme is coming out of Alex Steele today here, because that really does sum it up. We talk about the early start to the week, and markets really being shocked by that surprisingly strong reading on U.S. consumer inflation. And then we end the week now with a bit of a shock over that surprisingly strong producer price reading as well. Final demand PPI increasing month to month at triple the rate predicted by economists, and core PPI that was 5 times higher than forecast. Remember, several categories of that report are used to inform the Fed's preferred inflation measure. That's PCE, personal consumption expenditures. That next monthly reading on that metric, that hits in about 2 weeks. Now, it could have been worse, but there is palpable concern out there right now surrounding that last mile to the Fed's 2% inflation target, a target that Atlanta Fed President Raphael Bostic cautioned is still a bit fuzzy. In a speech just yesterday, he said he requires more confidence before declaring victory in the fight for price stability. Fed officials have now spent much of the first 7 weeks of the year really pushing back on market expectations for imminent rate cuts. And at least this week, the economic data helped to push back on those expectations as well. The swaps market 2 weeks ago was pricing in the equivalent of 1.5 percentage points of rate cuts this year. As of today, those expectations have been just about halved to less than 0.8 of a percentage point at one point in the session here. And that rate-sensitive 2-year yield, Alex, a 2-year yield that 1 month ago was down around 4.1%. Looks like we're going to end the week right around 4.7.
Which is why it's so impressive why we haven't seen such a huge drawdown within the S&P. And maybe a couple reasons to think about. One is Mary Daly. Earlier, she was talking about the fact we don't have to wait for inflation to get to 2% in order for them to cut. So they're going to wait, but still that threshold maybe not be as high as we thought. The other, in my mind, might be this something along this chart. This means don't freak out about inflation just yet. So the orange line is the 1-year University of Michigan inflation expectations. We got that today at 10. And then the white line is the 5-year inflation forward break even. Can't get the words out. It is Friday. If you can zoom in here, Matt, you can just really see there's nothing to get excited about. Both of these measures are actually holding or trending lower. And you have to wonder, the turbulence in the bond market maybe not yet reflected in the overall inflation expectations. Now, I was on radio. We were talking with Joanne Shu, Romaine, from UMich, who said that, look, that reading did encompass the CPI that we saw and we were surprised about for this week. It did encompass the PPI, and still, things are relatively calm.
Yeah, relatively so. 0.3% lower on the S&P 500. Given the big shock that we've had, you would have assumed the market reaction would have been worse. Let's get some insights out of Laura Rame, chief U.S. economist over at FS Investments, helping us kick off to the close here on this Friday afternoon. And I guess the question isn't so much were you shocked by the data, Laura, but were you shocked that we didn't see a more severe market reaction, at least today?
You know, I think I have been. And the piece to me that's missing is higher long-term interest rates. I think walking back these Fed rate cut expectations makes all the sense in the world. My forecast for this year has always been for only 2 to 3 surgical rate cuts. And that's a really important thing to add in, surgical rate cuts at the end of the year. I think looking at the data today, it's not just about CPI. Strong employment, the high wage number, I would have expected long-term yields to be closer to 4.5. Those have really, I think, stayed low, and it's probably because of the expectations dynamic that Alex hit upon.
I am curious to get your thoughts on the potential of where rates go next, whether they have to go down. I want you to take a listen here. We spoke with former Treasury Secretary Larry Summers just a little while ago, and listen to what he had to say.
I think that May is odds off at this point and probably should be odds off. And gosh, I think we've got to recognize what no one's talking about. There's a meaningful chance, maybe it's 15%, that the next move is going to be upwards in rates, not downwards in rates.
Former Treasury Secretary Larry Summers, he was speaking with David Weston, and to paraphrase and cut through the noise here, basically saying there's a possibility that the Fed might find reason to hike rates this year rather than lower them first. Do you anticipate that?
I don't anticipate a rate hike, but I think it's important to recognize that what would be the Fed's nightmare scenario is if they cut too much too fast and then have to raise rates at the beginning of next year or backtrack in any way. I think for that reason, they are going to be very careful when they cut rates. And look back at 2014, 2015, when the Fed wanted to raise rates. Back then, rates were zero. The Fed signaled the desire for liftoff, and yet it took them almost 2 years to actually get there. I'm not saying that's going to happen, but we need to recognize that the data don't always align and the markets don't always open the opportunity for what the Fed says they would like to do. They have a bias to cut. It's clearly something that they want to take the first step on. But as long as we're sitting at fresh highs in traditional equity markets, and as long as the inflation data are not cooperating, they could stay on the sidelines for longer than even they anticipate or they want to.
So to that point, even if there isn't an actual hike, if they stay on the sidelines, we have to price out even more of those 3.5 rate cuts that are priced in. Are we de facto tightening economic conditions and actually inadvertently hiking here?
Yeah, I mean, I think you bring up a really important point, which is this real yield move. And I think this is where inflation really matters. If inflation stays at 3%, the Fed funds rate stays at 5%, that's real yields around 2%. I think the Fed's initial idea was that inflation was going to come down to 2%, maybe even overshoot. And so by leaving rates where they were, it was sort of a de facto tightening. But today, I think if inflation stays sticky to the upside, really, real yields aren't rising as much as we initially feared. Right. And all of that in the background leads to financial conditions being very easy, something that we all see.
Okay, so is it possible that actually everything is fine? Like markets are going to bump around out here. We're going to have a larger range than maybe we're used to in the Treasury market, but now we kind of know what that range is. That growth is fine. That inflation will eventually come down, and the Fed will cut before we get to 2%.
That is such an important point. It's not, when we talk about challenges in the market, things like traditional equities being expensive. These are challenges not necessarily for bad reasons, right? It's a pretty good economic outlook. I think going forward, the good news is the world where, there was no alternative but equities is over. Today, you have the higher return yield. This higher yield world means that even things like high yield, a lot of credit opportunities are also giving you double-digit opportunities. For us analysts and portfolio allocators, it's actually a great world to be in because you can balance equities with a lot of other higher return options and alternatives. And I think that's not necessarily bad news at all.
All right, Laura, going to have to leave it there. Great insights. Laura Raim, Chief U.S. Economist over at FS Investments. We're going to continue our conversations about the markets and the economy, but some breaking news in the world of politics involving former President Donald Trump, of course, the front runner for the Republican nomination in the latest presidential cycle, ordered in a New York civil fraud trial to pay $364 million in damages. We're told that amount could climb to as much as $400 million if you factor in interest on that. Remember, this trial, one of the many trials that the former president is facing, centered around his claims of wealth and whether he inflated those claims in a fraudulent way. A judge ruling just that and saying that the former president owes $364 million and will be barred from operating a company in New York for at least 3 years. That ban also applies to his two sons, Eric and Don Jr., who will be banned from running a company in New York for at least 2 years. Kaylee Lyons down in Washington right now has been following this story and all of the other developments around the former president. Hard to keep track, Kaylee, of which lawsuit is which here. Set the context for us and what's Trump's options right now, given the verdict.
Well, of course, Ramin, this is one of the multiple civil cases he was facing brought by the New York Attorney General, Letitia James, who had asked for $370 million in damages paid for fraudulent activity that Trump undertook as part of the Trump Organization. Of course, he had already been found liable for that fraud. That was not what was in question here. It was how much she would have to pay. And the judge has now ordered that payment of $364 million. And as you mentioned, Ramin, there is interest potential here. The other big question that we have answered is how this impacts the former president's ability to conduct business in New York going forward. The court has found that Donald Trump, as well as Alan Weisselberg and Jeffrey McConney, are barred from serving as an officer or director of any New York corporation or other legal entity in New York for a period of 3 years. This also, as you mentioned, affects other members of the Trump family. His two sons will be barred for 2 years. So essentially, the takeaway here is that the Trump defendants have lost all of their claims in this civil fraud trial in New York. Of course, this is a civil trial. He also has been in a separate civil trial related to defamation of E. Jean Carroll, ordered to pay her more than $80 million in damages. And then there's the multitude of criminal cases he is facing. We found out this week that he will be in court, in trial in New York, beginning on March 25th, in the criminal case brought against him by Alvin Bragg related to hush money payments paid to porn star Stormy Daniels. So all of this just adds up to a very expensive multi-front legal battle that the president is facing, ordered now today to pay more than $360 million as a result of this case in particular. 30
days, of course, to post that bond. The question is, does he have it? And of course, the bigger question is, will this, if at all, affect his chances of becoming president once again? A developing story. We're going to continue to dig into details, and we'll check in again with our team down in Washington as soon as we get them. But we turn our attention back to the market, and all eyes on NVIDIA, the high-flying maker of chips for AI, set to report earnings next week. We're going to give you a full breakdown of the key numbers to watch.
Plus, our stock of the hour is Nike, the sportswear giant saying it will slash its global workforce to reduce costs.
And more concern for the commercial real estate sector. Interesting report here. The Fed's chief bank watchdog weighing in on the situation. You definitely want to hear what they had to say. Now, all that and more coming up in just a bit. This is The Close on Bloomberg.
All right, so we have tech stocks could be in a bubble. That was the fun note that came from the team over at Bank of America and Michael Harnett. He said also it could be in a position of popping. They look at a handful of indicators like bond yields, valuations, price action, all pointing to that bubble territory. But if they look at past indicators, they also point out you could have even more of a rally before that pop happens, which creates a problem when you're trying to put together a portfolio. Here with her perspective is Susan Schmidt, head of public equity at the State of Wisconsin Investment Board. I feel like that's a perfect way to set this up because it's like you can't live with them, can't live without them. When it comes to, say, big tech.
It's the perfect conundrum for an investor right now. And so it is really hard because we've seen such a run in these stocks already. They've been the strongest part of the S&P for earnings thus far, fourth quarter earnings. The majority of the earnings gains that you've seen have come in those tech stocks. If you pull that out, the whole S&P is really, earnings have been about, flat, up 1%, down 1%. So you're seeing that strength in tech continue. The market's certainly rewarding those stocks and the companies for it. And you've seen those prices keep appreciating. Can't live with them, can't live without them. I do think there's still backdoor ways to move into that space, and that's the hard. So AI, we're stock pickers, and so we run a concentrated fund. We're really trying to find unique opportunities, idiosyncratic. The AI play on the surface, those stocks have run a ton. But I do think there's still ways to backdoor in. Data centers, obviously, everybody knows it. Everyone's heard of NVIDIA. Interestingly, we didn't really hit the NVIDIA craze. Remember, they reported earnings it hasn't even been a year since we've been on the AI thing. Yeah. So beyond that, there's a ton of componentry. There are a lot of suppliers into those data centers. You need cooling, you need power, you need water. There's lots of different ways to play it. We're trying to find those backdoor approaches into it where the valuations aren't quite so extreme yet.
When do you think you'll have the confidence to do that? Because we've seen a lot of names crop up now, because I think everybody's searching for what else beyond NVIDIA, AMD, Microsoft, or whoever whatsoever. And you're seeing, obviously, Supermicro has been a beneficiary of that. We had the 13F filings out of NVIDIA this week, which showed investments in like a pharmaceutical company and NanoX, and they're like,
they're broadening out.
But it was like, oh, there's real applications for this stuff now. This isn't just hype.
Right, and I think you're going to see that, hopefully you see that in 2024. 2023 was such a narrow market. We saw just a few stocks really lead the way. If you weren't in the right stocks, you just weren't keeping up with performance. And so I think we're going to see that broaden out in 2024. I hope that NVIDIA announcements were kind of a cue that there is more application here. It can broaden out just beyond the tech plays. And hopefully we see that. I do think the general mindset for investors is we're in for a soft landing, and we can start to appreciate what other companies can deliver.
Well, just real quickly before we move away from AI and NVIDIA, because there's been a lot of discussions about creating new chips suppliers. Obviously, Sam Altman and his $7 trillion request to sort of build something. Masayoshi Son has also said he's willing to commit $100 billion. Do you think that there is a viable alternative, or it could be a viable alternative to something like NVIDIA that is pretty much created from scratch rather than just an existing company that scales up to it?
Right. I think we've learned in tech, never say never. Right. Development's always possible. The question is the time frame. And what's your time frame on that development? And so certainly there's nothing now that's just waiting where we already have the blueprint. And even if you want to develop it now, think about the time frame of building out a fab and getting to that. So it's still a long ways off. And I think that's why the market is focused on the players that we have now. They're certainly going to be in the lead for the near term.
How do you just barbell that to if and when we see a big decline? Because this is going to be a long structural shift.
Right. It is a long structural shift. So I think you're actually a little bit early to try and barbell that because we don't know what else is out there yet. I think you have to try and find diversified plays. AI is going to continue to run. You know, I just mentioned this is less than a year into the big AI hype. We have a long way to go here. The market clearly isn't ready to scale back on this. It continues to be a juggernaut. So I think that's where we're trying to play it safe, that barbell, find the backdoor plays in. I think those companies still have a lot of run as well. And that's what you have to do to balance it out.
All right. Well, so a great conversation here. The
Come
best and brightest, Alex, always from Chicago, and the best and brightest right here on the close. Susan Schmidt, head of public equity at the State of Wisconsin Investment Board. And we were just talking about NVIDIA, so let's go right there. When we come back after the break, we are going to talk about the stakes heading into earnings next week with the big rally in the shares and a big question about valuation. D.A. Davidson's Gil Luria on deck. Stick with us. This is The Close on Bloomberg. All right, looking ahead to next week when the behemoth in the AI world, NVIDIA, reports its quarterly results. It is going to be a crucial test, not just for the stock, but really for the entire market that has been hanging on everything that NVIDIA does, and more importantly, wants to see whether there's anything broader than just that name. Gil Luria joining us right now. He's D.A. Davidson's senior software analyst, managing director there as well. He has a neutral rating on the shares. And Gil, I don't even know where to start here. I mean, are the numbers themselves even going to matter? I feel like everyone just wants to know, what is that long-term growth story? How much market share do they have? And more importantly, what, I guess, rabbit that Jensen Huang has up his sleeve or on his hat or whatever the euphemism is.
Yeah, I mean, let me kill the suspense for next week. They're going to report a fantastic result on Wednesday after the close. They will clearly do better than expected, better than guidance. Their customers want more and more of their product. Their supply is increasing. The result itself is going to be fantastic, and it's going to be a great reflection of where we are and where we have been in terms of excitement about AI, where it's headed, and where its big customers want to be. So we already know that. We can be very comfortable that that's going to happen. And to the extent that's what people want to see, they're going to get that. The conversation about the out years is going to be the more nuanced one. And they've addressed it in the past. They're going to continue to address it on the call. But I don't think they're going to be able to resolve anything quite yet in terms of results for 2025 and 26. Which is what really matters.
How much of a runway? I mean, in terms of, I'm talking about with the stock price and the valuation there, a stock that has already started this year up 48%. It's up more than 400% over the last, 14, 15 months or so here, Gil. I mean, I get it. There's obviously a lot of promise here. But at some point, you have to look at this price and say, is this really justified in the here and now?
Well, this is the great week to have that conversation, because let me position two options for you. If you could own the whole company, the entire enterprise, and in one side, I'm going to give you a company that has a $100 billion hyperscaler, $50 billion advertiser growing at a very fast rate, and a retailer that has such advanced logistics, nobody's even bothering to compete with them. Or if you want a $100 billion hardware company at the very, very peak of demand. I think once you look at it that way, before you say Amazon the stock and NVIDIA the stock, I think it becomes evident where we are at this point in time. The demand for NVIDIA's product is off the charts right now, but it's a hardware product. And once all of its customers stock up on it, they're not going to need to buy it again. And therefore, the estimates for the out years are getting so out of hand that I think we need to step back and think more about that than how good the quarter is going to be next week.
Which is probably why we're seeing a lot of call buying into the quarter rather than puts, and rather than like straight up buying in the stock. To that point, Gil, I'm wondering that next wave of growth, though. Like, I hear you. Like, once you stock up on all the stuff, you're not going to need any more stuff. But they're positioned for that, right? Like, they're looking beyond the cloud service providers, et cetera. What is that next leg of growth, even if it's a few years out?
Well, so they do have some recurring revenue base, and they're expanding that as we speak. But let's call that $1 billion out of $100 billion. That won't be enough to sustain the business once its big customers feel like they have enough, A. B, the models for AI are getting smaller, not bigger, and therefore that capacity may last us for a while. And then C, even if it doesn't, the competition that's coming isn't from upstarts. It's not that far out. It's from their biggest customers, companies that are even bigger and more powerful, Microsoft, Meta, Amazon, Google, building their own chips, investing in their competitor AMD. And as your colleague Jillian Tan from Bloomberg reported a little while ago, SoftBank investing $100 billion. There is more competition coming for AI chips than we've ever seen for any other category of any other product ever.
All right, Gil, thanks a lot. Fun lead up. Next week's going to be interesting. Gil Luria over at D.A. Davidson. I don't know. I'm off. I'm going to leave all that to you, Romain. But I think the point is, so much is in the stock already, as you're pointing out, and then so much call buying in the stock already, too.
Yeah.
It's a little confusing.
And a lot of activity in the options market. The other thing, and then someone pointed this out to me a couple of days ago, a big money manager, he said, people are really looking to broaden out away from just NVIDIA, and that it's really been the beneficiary of the fact that there really wasn't a lot of sort of pure AI plays out there, right? It was kind of them, maybe AMD, maybe Microsoft, maybe Alphabet. But now people are starting to wake up to this whole sort of ecosystem surrounding NVIDIA, and I think maybe some of the money starts to flow there as well. Doesn't necessarily mean that kills NVIDIA. It just means that people
as you're mentioning, Supermicro, for example. The FT had a really interesting piece on out, though, about the concerns around that stock as well. Anyway, it was interesting. All right, coming up, we're going to talk with Laurel Durkee. She's head of global listed real estate assets at Morgan Stanley. This is Bloomberg.
Just about 3:30 p.m. here in New York. This is the countdown to the close. I'm Romain Boston.
And I'm Alex Steele. And sure, the S&P is off its highs. Yes, it's off of record highs, but just down 0.3%. Still quite a run, I have to say, this week.
And it's interesting. Like, most of the major indices look like they're going to finish up on a weekly basis, which is a huge turnaround from where we thought we were going to end after that big day on Tuesday.
That's right. And volume's light. You got a long weekend.
Yeah.
I've been asking the question all week, sort of what's going to disrupt the rally? Like, what's going to change the buy the dip scenario? And you could have made the argument that banks and commercial real estate and that risk was going to really spread throughout the market. You know what? That just hasn't happened yet. On an individual basis, maybe. Now, everyone, plus the Fed, is weighing in on that story.
The Federal Reserve has issued more supervisory findings and downgraded firm supervisory ratings at a higher rate in the past year. In addition, we have increased our issuance of enforcement actions.
I do have a concern about commercial real estate.
We've had $2.8 billion of loans repriced in the last 12 months or mature. We have not had to restructure one loan. at that whole $2.8 billion.
You can feel the stress in the commercial real estate area.
We don't see it as a sector where yet we see real opportunity.
I'm actually optimistic. I think that the markets are proving to be resilient. There's enough liquidity to resolve these.
I believe it's manageable, although there may be some institutions that are quite stressed by this problem.
I would continue to believe that these isolated instances like New York Community Bank are going to be resolved.
But it's a problem that'll have to be digested by the markets over a number of years.
Let's bring in Laurel Durkee, head of global listed real assets. I cannot read today at all at Morgan Stanley Investment Management. Sorry, Laurel, it's Friday. I can't see the prompter. It's over for me.
Totally fine.
Okay, so you just heard a lot of heavy hitters, big officials there talking about their commercial real estate risks. What do you think?
There are certainly a lot of divergent opinions, and I think the most important fact is that you can't paint real estate, commercial real estate, with the same broad brush. There are some sectors and areas that will be challenged. Office real estate is one that has had an impairment to value and their cash flows. But there's a lot of sectors that are doing really well despite what the headline is and what the negative rhetoric is.
Like what?
So when I'm thinking about what sectors look really good, it's the secular drivers of demand that are underpinning why these sectors look good. So aging demographics is really favoring seniors housing right now. Take a step back and just think about the U.S. is actually experiencing over the next decade a growth in the 80-plus age cohort that is more than double what we had experienced over the prior decade. So you're seeing 80-plus-year-olds grow about 4.5%. Over the last decade, it was about 1.5%. 8 million new people added to that age group versus the 2 million that had been added before.
Right.
That's going to require a significant amount of new supply in the seniors housing space. And we're actually seeing supply at almost 10-year lows when thinking about the dynamic there. And so that's resulting in significant growth in values as well as actual cash flows for the seniors housing segment.
Is the money starting to flow there, though? I've heard these types of stats or similar stats before here, when in terms of dealing with what is effectively now a deficit in terms of capacity to accommodate all those folks. When does that building start? When does that money flow, or has it?
So what you did see pre-COVID, there was more supply coming into the market, and you had elevated levels of supply coming in, certainly versus history. However, since about 2020, you've seen that drop off precipitously, exactly at the same time when we're seeing the age cohort really grow. So I do believe we will see new funds being deployed into the space because it's necessary, it's required. But what we need is for the actual cost of construction to come down a little bit, and the economics to pencil in a way that they're not exactly working today.
I know you're focused on sort of those opportunities going forward, but I have to ask you about the current state of the office market and whether you find any opportunities there. There was a relatively encouraging report by CBRE yesterday where they kind of said, look, I mean, they were cautiously optimistic, so I put it in quotes, but they basically said they thought the worst was over. And we've seen a couple other reports from SL Green and a few others that also seem to suggest, at least for Class A properties, that worst case scenario is probably off the table.
So huge divergence in the trophy Class A office buildings versus everything else. So when you look at a market like New York City, it's about 425 million square feet of office space. Maybe half of that is Class A. When you look at the vacancy rate in New York City, it is upwards of 20% right now. And market rents are continuing to, on a net effective basis, come down. That is going to create a continued drag in cash flows and likely result in value impairments across the space. Utilization levels in New York are hovering versus pre-pandemic levels are hovering around 50%.
Yeah, you just go outside, like go on Lex.
It's a Friday. No one's in the office.
Like
no one's here.
I mean, we're here.
Yeah,
but
it wasn't much different on Thursday.
No, it really wasn't. Like you got Sephora and you got Bloomies, you got us. Like that's pretty much over the last couple blocks. So shouldn't they all just become data centers? And that's just my way of asking about the growth of data centers.
Well, you do certainly have a significant opportunity within data centers. And if you think about the growth of digital data over the past 10 years, it has been robust. And that has been a huge demand driver for data centers. But what's happening right now, which is even more exciting, is the artificial intelligence demand boon to the data center space, which really is simply incremental and very additive to what we're seeing from a demand perspective. This is happening at the same time when supply into the area is much more limited than it has been historically because of power availability challenges. That's not something that's going to be solved overnight. This is about power generation as well as power transmission. And so those landlords out there that have already secured power and can build into this artificial intelligence demand are really going to be very successful.
So this is like how do you do that? Or how do you find those REITs? This is very specialized.
Sure. So there's two REITs that really specialize within the data center sector. They're Digital Realty, ticker DLR, and Equinix, ticker EQIX. Both of them reported this week and had divergent results. So Equinix was able to report some really good numbers. They are able to develop in their joint venture program to the hyperscalers who are really looking for this AI data center build out.
Yeah.
Digital Realty, on the other hand, while they have significantly benefited from AI, they reported last night and had some disappointing earnings guidance.
Yeah.
And so they're underperforming today. But when you look at the long-term demand drivers for both of those stocks, they're very well positioned and will likely experience above average cash flow growth for several years to come.
All right, Laura, this is a great conversation. Great to catch up with you here. And at some point, we have to talk about all the other things proliferating in New York real estate today. Laurel Durkee, head of global listed real assets at Morgan Stanley Investment Management. Alex, I have a feeling at some point we're just going to walk down the streets of New York and everything's just going to be data centers and bank branches and
with
Chipotle.
Coffee.
Yeah.
Well, we talk about that a lot, that PNC is opening more branches, JP Morgan's opening a ton of branches. It's why? No one actually banks. It's just basically a pure PR thing. Put it everywhere. People think about you, and then that's it.
You want to know why, Alex? It's cheaper than a television commercial.
But is it? I mean, generally, or a billboard. Remember those billboard things that you saw?
I don't know. Do people still pay attention to those? All right, coming up here, a focus here on some of the big movers of the day. Stock of the hour is Nike, joining a growing list of companies kicking the year off with staff cuts. The full breakdown here of why and what's next. That's our stock of the hour. It's coming up next, right here on The Close on Bloomberg. Welcome back. It's time now for our stock of the hour and taking a look at shares of Nike. Shares moving lower here after the company said it's going to cut its global workforce by about 2%, putting Nike in what it says is going to be the right size to address weaker sales and growing competition. Our very own Abigail Doolittle joining us right now for a breakdown here of the move lower. Not a massive move lower, but we kind of got a taste of this. It felt like it was last month or the month before where they kind of warned that they were having some issues and they were going to focus on cost cutting.
And they certainly did today with the workforce cutting that you're talking about and also simplifying the product line, as you mentioned. What this is really a story of lumpy growth, because if you go back to 2019, their growth on the top line, it was 19%. The last year, it was 9%. This year, it's expected to be about 1.2%. So that robust top line growth that they had that was flowing to the bottom line, not so much. So they're focusing on the cost cutting, 2% of the workforce, more than 1,600 people to flow to the bottom line. But they're also talking about simplifying the product line.
Well, that's what I'm curious about, because is cost the real issue here, or the fact that
I think it's both, because they're talking about a cautious consumer. And so I think that's a big piece of it. So one analyst who downgraded the stock, the analyst at Oppenheimer, saying that it's the sluggish sales, but also the lack of innovation and then also competition. So I guess lack of innovation means lack of super hot
Yeah, they don't have anything hot. And then,
it's like $200.
And then you mentioned the competition. It was like, well, you got Hoka and the other
you have
brand,
everything.
I don't know, man.
On Cloud. And,
you were really hip on shoes.
stuff.
Like, I don't know if you guys know this, but like every day we got a new pair of shoes.
I don't disagree with you. And
So
yes.
I think if someone knows footwear, it's going to be Romaine.
Romaine. So what sneakers do you wear, Romaine?
Yeah, do you wear sneakers?
Yeah, I've been a Nike guy pretty much my whole life.
Oh, so you're supporting.
Yeah, I support them, but I don't buy like the really high-end, fancy ones.
Sure.
You know, that probably get.
So I have a pair of the
believe
Air
in butt at all.
Jordans, children. They're patent leather, black, gold, and white. And anywhere I go, people compliment me on them. It's like my #1 clothing item ever.
You wear
but
Air
they're not.
Jordans?
I do, and they're
Abigail,
kids.
I don't think
They're
I've ever.
kids.
They're
kid size?
That was the style.
I don't think I've ever seen Abigail outside of the office.
Sorry.
So I've never seen
men's. So there are 7 men. There were men's. It was like from the
because
special
kid size. We were about to have a whole nother conversation.
I get better. I get more compliments on those sneakers, like crossing the street, on the train, anywhere that I'm at. So they have some style.
Okay, sure. And also China. To your point, it's
Nice
definitely
segue.
Thank you. We were talking to Poonam Goyal on radio earlier, and she was like, it's not just China, though. Like, it's weakness everywhere. But clearly China, for any retailer that has a huge amount of dependency on that, will be an issue.
Absolutely, because last year it was 14%. A couple years ago, it was closer to 20%. So 6% of their revenue base has gone away from China. So the lack of rebound out of the pandemics. And then also, some analysts are talking about EMA, Europe, Middle East, and Africa. That's 26%. Apparently, there's a little bit of a slowdown. So maybe the tightening of products will help bring some kind of a pop. What all these analysts agree is that the long-term good is good. It's the near term that is a little bit challenging.
So do you go down in size for men's size shoes? Like
my feet have actually shrunk. I used to be an 8.5, 9 ladies. I'm now 7.5, 8. I think men's like 6.5, 7. It's strange. It's like the only person that's. But those sneakers, I'll wear them next week for you, Romaine.
I want to see them. I didn't know you were a sneakerhead.
We'll have a reprieve here.
Abigail Dillard walking around in her Jumpman.
Certain men's shoes are pretty
This was the
cool.
best segment of the day,
Anyway,
Alex.
we nailed that. Thanks, Abigail. All right, coming up, we're going to count you down to the closing bell with Brian Levitt, global market strategist over at Invesco. This is The Close. This is Bloomberg.
This is the countdown to the close. Romaine Bostick alongside Alex Steele. 6 straight weeks of gains for the S&P 500. Alex, coming to an end this week, but you know what? It could have been worse.
It could have been worse. The S&P for the whole week down by about 0.4%, but the Russell is still up on the week, which I find kind of interesting.
Yeah.
And if you take a look at the best and worst performing sectors on the whole week, you're looking at materials and energy doing really well in the S&P, and I know, shocker, tech, one of the underperformers. So definitely still the cyclical trade, right? Materials, energy, and the Russell still doing pretty well in the week.
It's interesting, and it kind of gets to this idea that I think a lot of investors really do want to see a broadening out of this rally. So they're looking for any excuse to sort of get away from just the Magnificent Seven. But of course, tech stocks have been the dominant, real gainers, if you will. It's been dominating the conversation, and it is going to dominate it ahead of NVIDIA's highly anticipated results next week. We had a chance to catch up with Susan Schmidt about some of the sky-high valuations out there. Take a listen.
They've been the strongest part of the S&P for earnings thus far. Fourth quarter earnings, the majority of the earnings gains that you've seen have come in those tech stocks. If you pull that out, the whole S&P is really, earnings have been about, flat, up 1%, down 1%. So you're seeing that strength in tech continue. The market's certainly rewarding those stocks and the companies for it. And you've seen those prices keep appreciating. Can't live with them, can't live without them.
Susan Schmidt, who runs public equity over at the Wisconsin Investment Board, really talking about the concerns about valuations. Let's get some insights out of our next guest, Brian Levitt. He's joining us now to help us count down to the close, global market strategist over at Invesco. And Brian, I do want to start off with what Susan was talking about, which is that, as much as we obsess over the sky-high valuations on some of these names, she makes a good point. I mean, if you're looking for cash flow, you're looking for growth on the revenue side, you're looking for growth on the bottom line. Unfortunately, those big cap tech stocks are kind of the main game in town.
Yeah, those are the companies that have been delivering. And when people talk about an overvalued S&P 500, a lot of it is more concentrated in a handful of names. And, we could say that those companies should be rewarded. They should be getting a premium to the broader market. Now, if you look at the rest of the 490 names, or you look at an equal weight S&P 500, the valuations are not all that excessive. In fact, pretty much in line with long-term averages. The other thing I would say on valuations, if you compare the earnings yield of the market to the bond yield, it's about even. So, stocks are neither cheap nor expensive to bonds.
Do you worry at all, given sort of the, I guess, surprise reports, if you will, that we got this week on inflation, CPI, and PPI, that relationship right now, when it talked about that differential between what you have in the Treasury market and the yield that you get in equities, could we see a material jump in benchmark Treasury yields to the point that maybe it makes that differential a little bit harder to stomach?
I don't think so. Yeah, we did get slightly hotter than expected consumer price index, producer price index, although 3.1% year over year on headline inflation after we were at 9.6 doesn't seem all that bad. I know we expected a little bit better than that. The other thing is, if you strip out shelter, now people say, why would you strip out shelter? You strip out shelter because it lags the way the Bureau of Labor Statistics calculates it. If you strip out shelter and you look at a core CPI year over year, it's 2%. So very much where the Fed wants it to be. And shelter is likely to come down, given what's happened in the real world. You know, we saw the Case-Shiller home index go negative year over year. That was last year that happened.
So I guess, Brian, the question becomes for me then, how do you hedge it? How do you hedge all of this? Like, you still have to be in the stuff that you may not want to be in, but how do you do that? And then where do you find the safety trade?
Yeah, I mean, like if you are concerned, I guess it depends what you're concerned of. My bigger concern would be a weakness in this economy, not a reacceleration of inflation and not a big spike in interest rates. So if you're worried that we're going to have a slowdown in economic activity, then you do want to be higher quality, and those more concentrated names will continue to reward you. But if you're thinking beyond the next couple of quarters to, you know, a soft landing and beyond, a normalization of the yield curve, well, then markets should broaden out, and you should think of equal weight or, you know, more value-oriented or smaller capitalization strategies.
Hey, Brian, what do you think happens next week with NVIDIA? How does that wind up affecting the market?
Well,
and is that a bigger deal than, like, the CPI?
It's going to be front and center. I mean, anytime you have these names that are making up 5% of the broad market, it's going to be front and center. And it is a stock that's priced with a lot of optimism. So on the off chance that they underperform, then there'll be some impact to it. But it would be short-lived. You know, again, I think investors need to keep their eye on the ball here, which is we have seen peak inflation. We've likely seen peak tightening. We've seen peak interest rates. That's a good backdrop for stocks over the subsequent years.
Do you think, though, we maybe are ignoring the potential for, I guess, something to get in the way, whether it's not the Fed itself here? Of course, we have a big election year here in the U.S. and quite a few other consequential countries this year. Anything on there that, I guess, maybe that you have your eye on?
One thing I tell people about elections is that they don't matter for markets nearly as much as people suspect that they do. And one of the examples I'm using right now is if you look at the first 820 days since Joe Biden was elected, the market's up about 50%. If you look at the first 820 days since Trump was elected, the market was up about 50%. So very much neck and neck. I think it's a market that wants clarity. It's not likely to swing too far one way or the other based on outcomes of elections. It wants monetary policy clarity, and maybe you get a little bit volatile ahead of the election. But ultimately, so long as the market knows the rules of the game, understands what policy is going to look like, we should be in a good backdrop for equities.
Do you feel comfortable in that, though, the idea of knowing what policy is going to look like no matter who ends up winning in November?
I do. Think about from monetary policy perspective, which is likely to matter most. We have better monetary policy clarity than we've had in a while, which is a good sign. Now, on the with regards to the executive branch of government, I think people go too far in thinking that when you elect the president, they get everything done that they want. First of all, you have to control Congress as well. The same party has to control Congress, which is still up in the air. And even if you get single party rule, as Obama did briefly, as Trump did briefly, as Biden did briefly, you end up getting a couple of things done. And then that party seems to get kicked out of Congress in the midterms anyway.
Yeah. All right, Brian, one last question for you. Is Michigan going to repeat this year?
Oh, you know the answer to that, Roman. Absolutely.
Brian,
Go Blue, my friend.
Brian, great to talk to you as always. Brian Levitt, global market strategist over at Invesco, helping us count down to the close with about 2.5 minutes to go. We're actually near session lows, Alex Steele, but you know what? Could have been worse.
It could have been worse. Also, let's be honest, no one's going to want to take risk headed into a long weekend. You don't know what's going to go, and especially going into NVIDIA as well.
Yeah.
So there's two kind of events there. But again, for the week, we're down 0.4%, but could have been worse.
Yeah, NVIDIA certainly potentially going to be one of the big catalysts next week. We're going to break down all the market moves of today, of the week, and looking ahead to next. Stick with us. We're about to take you to the bell and beyond.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick here with Alex Steele. We're counting you down to the closing bell. You're here to help take us beyond the bell. It's a global simulcast with the entire family. Scarlett Fu here in our television studio. Tim Stenovic in the radio booth. And, Carol Massar apparently didn't get the memo. So we welcome Emily Grafeo filling her seat here on a pretty consequential week, Tim, here. That 5-week win streak for the S&P and the NASDAQ coming to an end.
Seeing some selling late into the session here. But you know what? You're probably not surprised to hear this because you guys know Sylvia Jablonski well over at Defiance ETFs. Scarlett, she's still bullish. She says use opportunities like what we saw on Tuesday, use opportunities like what we're seeing today late in the session as opportunities to buy. That said, she still sees some risks to the market out there, including inflation going the wrong way and surprising us. She would not consider the data that we saw this week as doing that. And then geopolitics, what's happening in the Middle East.
Yeah, geopolitics certainly a concern, but then you look at how it's affecting oil prices, and the answer is not very much. So while it does weigh on sentiment, the net effect when it comes down to it is that it's something to keep an eye on, but it hasn't really stopped anyone.
And it really is the question of what do you do when there are all these concerns, but they're not being reflected in the market? Do you kind of go with the flow and risk a blow up top at some point? Do you actually have to sell or short into rallies, which have been very, very short lived when you see the buy the dip scenario, or you just buy a bunch of options and just sit there and just wait for that to be realized?
Yeah, it raises a lot of questions, though. I mean, is the market that lopsided? I mean, on the surface, it looks that way, but how many people have we had on our air here who kind of say that when you really dig deeper under the hood, it's a little bit more balanced than maybe what it seems like on the surface? All right, guys, this was a pretty fantastical week, one way or the other, no matter what you want to get out of it. I mean, you go back to Tuesday and that massive sell-off and then the big 2-day rebound on Wednesday and Thursday. We're down here on the day, and it looks like we're going to be down on the week across the board with the Dow Jones Industrial Average lower by about 0.4% here on the day. That's down by about 145 points, and that's going to be lower on the week by 0.1%. The S&P 500 lower by 0.5 percentage point on the day and on the week. The NASDAQ down 0.8% on the day and about 1% on the week. While the Russell 2000, that was your laggard on the day, but your outperformer on the week, down 1.4%.
A good reminder every once in a while that stocks don't only go up. Sometimes they do have down weeks, at least in the last 3 months, Scarlett. If you do peel back the layers of the S&P 500, 169 stocks in the S&P 500 moved higher, while 330 moved lower.
All right, let's take a look at the sectors and really show you how that played out. On the downside, the leaders, when you look at decliners, are communications services, and that's your Paramounts, your Warner Brothers Discovery, real estate investment trusts, and tech overall. The ones that bucked the decline, materials, Vulcan Materials, Albemarle leading the way there, healthcare and consumer staples.
Okay, well, let's take a look at some of the decliners. No shortage of those on a day like today. Even though we saw Applied Materials finish off of the highs that it reached earlier in the session, it did still finish the day higher by more than 6% on the day, hitting an all-time high today. Shares closing at $199 per share. It's the largest U.S. maker of chip-making machinery. The company did issue a strong forecast for the current quarter. We covered this late yesterday when that report came out. Analysts did say that the results and outlook were boosted by DRAM memory chip equipment revenues and demand from China. And then check out shares of what happened with Eli Lilly today, up another 3.2% to trade at more than $782 a share. Morgan Stanley came out with a note that said that Eli Lilly could become the first biopharmaceutical company to reach a market value of $1 trillion. Morgan Stanley also increasing its price target on the stock by almost 20%.
I thought it was interesting, though, but the price target is $950, right?
Yeah.
And then, so if you do the math, that's basically a $900 billion market cap. So if it's going to $1 trillion, why not give it a price target?
Almost.
$1 trillion.
What is interesting, though, is that
could become.
It's not a tech company.
No.
Like that's what makes that interesting. The same idea with like a Novo Nordisk, et cetera. Like that you can get there without being big tech.
Right. And I was looking at that, too. I mean, how many tech companies are even close to that level right now? None, right? I mean, it was like Berkshire and that's it.
Well, I mean, there are companies that have passed that, like, of course, the Magnificent Seven.
Yeah, I'm talking
you
about
saying?
non-tech companies that are approaching that $1 trillion mark.
yeah.
Yeah, I'm saying, yeah.
Okay.
Yeah, sorry.
Yeah. It's all about, reminder, it's all about Zepbound and Mounjaro, those GLP-1 agonists that
Are you on that as well? Because that jawline, I'm so envious.
I feel like that's a HIPAA violation or some sort of like CCHR here. I don't know if I should.
Wow.
All right,
Emily,
let's talk
save us
crypto.
with decliners,
I'm going to bring the decliners
All right,
in now.
Hold on. There's one more. Coinbase did post a profit for the first time in 2 years after the fourth quarter rebound in digital assets. Of course, what we're seeing with Bitcoin above 50,000, helping that stock up about 8.84% on the day today. Emily, take it away.
Okay, now we're going to do the decliners. Looking at DoorDash, because that company saw its worst intraday drop since May 2022. It was down as much as 13%, now closing the day down about 8%. They had a pretty solid fourth quarter earnings report, but analysts noted that the recent run up in the stock really set the bar high. The shares were already up about 28% this year, but it was a pretty solid beat across the board. So what exactly does it say about the market to see such a drastic drop after the earnings? We'll have to take a further look into that. I'm also looking at shares of Block. That company was down about 5% on news that federal financial regulators are examining allegations that Block's Cash App and associated entities conducted inadequate due diligence on customers. That first came from an NBC report citing complaints made by 2 whistleblowers for Block. And then finally, decliners looking at Roku. Those shares were down 19%. Again, the earnings weren't that bad. The video company's first quarter forecast, though, seemed to fail to impress analysts, leading in a downgrade over at Oppenheimer. They took the stock from perform from outperform. They said, we see the stock range bound until the company sustainably delivers high teens platform revenue growth. That's Roku, the streaming company, finishing the day down over 20%. Alex.
All right, well, talking about decliners, let's take a look at the bond market. You're looking at the 2-year yield. Those yields are up by about 7 basis points, pretty much across the curve. What I do find interesting, though, when we talk about it could have been worse, 100% true. However, if you take a look at, say, a 30 JIP of the 2-year, we already had a sell-off in higher yields earlier in the month in early February, and another gap higher when you had that CPI data hit. So it's been a big re-rating. It just wasn't all in the last 3 days, Romaine.
Yeah, absolutely. And this kind of pushes us ahead, I think, to next week and sort of what is going to be the real catalyst here. I mean, we talk about the economic data that really rattled the markets, and we talk about, of course, a big earnings report next week with NVIDIA, guys. And it's not just going to be about NVIDIA itself. Everyone really wants to know about that entire ecosystem surrounding this company. And I mean, I don't know, if they say something nice, I mean, it could be off to the races. If they say something bad, then forget about it.
Yeah, it was like last quarter. I would say that that was one of the catalysts that sort of set us off to the races on the incredible gains that we've seen in the last 3 months. Hey, I want to shift gears and go back to what we were talking about with Eli Lilly. Do you guys remember over the last few months?
Let's do that, because you want to know why, Tim? I've gotten 3 messages since I commented about your jawline, saying that, yeah, they really like your jawline.
It says, Romaine, I'd like to see you after class in HR. But the reason we're talking about this is because we're actually starting to see some data where people who do use these GLP-1s end up spending less on groceries. Yeah. And this could have real implications for the companies that make food, the companies that sell food, and of course those snacking companies as well.
Yeah, and this is one reason why we had seen declines in some of those stocks. But of course, it only works so long as you take that medication. Once you stop that medication, you go right back to where you were before, and the snacking will return.
And this goes to, I was talking to the CEO of Novo Nordisk when he was in town, and he said, on the record, that food guys were calling him and really panicking and being like, is this really going to really hurt my business? How do I think about it? And they're like, we don't know yet. There hasn't been enough data, to Scarlett's point, because you have to stay on the drug in order to keep having the effectiveness. But clearly, it is already happening.
Well, you know, let's just say that you do take the weight loss drugs and you keep the weight off, then you can spring for a new wardrobe. And what I found fascinating, there was a great story.
The Botox. You got me.
The Botox, that too. If you go to TikTok, that's where fashion trends are born, and of course some die as well. Right now, what's in this had us talking all afternoon, is the mob wife look, Emily. Kind of a Carmela Soprano kind of look as the show celebrates its 25th anniversary.
What did you say, Scarlett?
It's a mob wife look.
Mob?
Yes.
Mom.
Mom
Faux fur, the faux fur look.
Yes.
Big sunglasses.
Big hair.
Big hair.
Little jewelry.
This is all over TikTok right now. Formerly, it was the clean girl look. So this was little to no makeup, hair pulled back, very simple clothing. And now, just like fashion trends, we have quickly shifted. Now what's in trend is mob wife aesthetic, a completely opposite of the clean girl. So you'll have to go stock up on that dark red
Emily,
lipstick.
what about business news guy?
That wasn't on the list.
I don't see this on the list here. Like,
it was
what am I
not on the
missing?
list. I'm sorry, Tim.
Okay.
You didn't make
Business
it.
news guy.
Maybe there's like a separate TikTok thing for that. But it also is actually quite interesting because it goes through a bunch of different looks. You have like the Barbie era, and it's all pink, 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 pink. And like you mentioned, the clean girl look. Then you have what was like night girl look or something.
Yeah, what is this?
Also, these are all women look.
There
Again,
was
like
one-
there's no night boy look.
So I have to admit, I read this story. This was one of the first stories I read this morning, and it was also the first story that I didn't understand this morning. Emily, I mean, as our chief, Gen Z correspondent here, I saw Tomato Girl in there. I never even heard of that.
I don't know
Office
what-
Siren,
I'm
which
not
sounds
sure
like an
what
HR
Tomato Girl
violation,
is.
and
Definitely
then
an
something
HR
else. Like I mean, I missed all those looks. I'm just now catching up with
Romaine,
Mob Wife.
you know Quiet Luxury, though, right?
Yeah, that I've heard of.
That is totally.
Yeah, I actually
insane.
interviewed the Norwegian wool guy, so yeah, I'm familiar with that. That's about it. But of course, I mean, the quiet luxury, that's for old people. I mean, what are the young people into right now?
Yeah, I have no idea. TikTok, not something that I've adopted at this point. But the good news is it's a long weekend. There's plenty of time, Romaine, for you to work on your mob wife look and post those TikToks, okay?
Make a very ugly mob wife.
That is going to do it for Beyond the Bell. We got to go. It's our cross-platform coverage of the market close on Bloomberg TV and radio.
Okay?
No.
That's it. We got to go. I'm expecting some TikToks on Tuesday, okay?
Oh, we got Friday vibes.
Yeah.
Romaine, you
Bloomberg
got to check out
Originals.
Coastal
Some
Grandma.
new clothes.
That's a new one, too.
Hey, meantime, if you do want to come back on Tuesday, catch us same time, same place. Have a good weekend, everyone.
All right, you know the vibes. It's Friday vibes, and it's time for our Factor Friday segment. We're going to break down the big factors that drove the market this week with Chris Kane. Stick with us. This is The Close on Bloomberg.
This is The Close. I'm Scarlett Fu with Romaine Bostick, and we got today's long-awaited PPI report muddying the outlook for Fed rate cuts. The bigger-than-expected rise in wholesale prices echoes the hotter CPI data, and what we saw was bonds and stocks both falling. The S&P 500 still holding on to that 5,000 level, but down 0.5%. The Russell 2000 falling even more. The laggard here among the major indexes, though, for the week, it did outperform. We should note the S&P 500 fell for the first time for a week since early January. And home builders under pressure after the Fed housing starts plunged in January. A lot of people blaming it on seasonal factors, but still, that was enough to take that group down by 2.6%. And of course, in Treasuries, the 2-year, the most sensitive to Fed policy. At one point, the 2-year yield rose to as high as 4.7%. That's levels that preceded the Fed's December pivot. So speaking of the Fed, here's how traders are digesting all that data. They're dialing back the number of expected rate cuts in 2024 to just over 3.6 to be exact. About 1 month ago, the market was pricing in 6 to 7 rate cuts. So the Federal Reserve, of course, on its own, through its members, has stuck with its forecast of 3. Let's go now to the actual movers on the day today. We're going to start with Toast, rising as much as 18%. The software company, which processes payments for restaurants, said that its full-year forecast topped analyst estimates, thanks in large part to its plan to cut staff by 10%, which was announced just prior to that forecast. Coinbase ending the day up almost 9%. The cryptocurrency exchange reported its first profit in 2 years and said that Bitcoin ETFs are having a positive impact thanks to elevated engagement. Those are its words. And Digital Realty, this is a real estate investment trust that's basically a data center REIT, gave a full year forecast that was weaker than expected. The stock lowered by almost 8.5%. And Dropbox losing 23% on the day. The file management software's fourth quarter results were seen as weak, and analysts are saying that with tech firms remain still cutting jobs right now, that may just reduce some enterprise customer demand going forward as well.
Yeah, of course, tech, one of the biggest laggards on a weekly basis in the S&P 500. Still, though, of course, the big winner on a year-to-date basis. And next week, well, it could change a lot, either for the better or for worse. Chris Kane joining us right now, equity strategist for Bloomberg Intelligence, for our Factor Friday. And Chris, you recently did some factor work specifically on the tech sector. What actually jumped out at you?
Yeah, so typically we do factors on the whole index, right? But now this week we did just on the tech sector. So going long the 20% of stocks within tech of the that have the best scores based on our factors, short the bottom 20. So when you do that and look at the regular or more traditional factors within tech, the thing that really jumps off the page is low volatility. So the low volatility factor is up about 70% just within tech.
Within tech?
Within
Really?
tech.
Interesting.
Just since 2021. And you look at those different legs, the low volatility tech is up about 40% in that time period. High volatility tech is actually down about 30%. Wow. So it's been a huge spread. The low volatility tech group is really driving a lot of the gains in tech just generally. And it was a really interesting finding.
Yeah, that is really interesting.
So these are like the defensive tech stocks. What do the fundamentals of these low volatility tech stocks look like?
So to not bury the lead, the fundamentals just seem way better for the low volatility tech sector. It's very rare. So basically, the low volatility tech group is both cheaper and more profitable than high volatility. And that's pretty rare. Usually when a group of stocks has higher profitability, the market rewards it with higher valuations. Not the case at this time. To put some numbers to it, the low volatility tech group is trading at about 3.5 times sales. The high volatility is trading about 7.5 times sales. On an ROE or profitability perspective, the low volatility tech group is about 18% ROE, and the high vol is about minus 16%. And when you look at the valuations, right, low volatility tech is less than half the valuation of high volatility. That ratio is actually averaged about 1% over the last 25 years, meaning the same. So it's very discounted and much more profitable, and that would kind of explain why it has really driven returns of the sector.
Well, let's talk a little bit about the actual stocks that sort of fall into the groups of low vol versus high vol within the tech sector. I'm going to assume low vol, particularly given that a lot of people think of some of those stocks as defensive. That has to be what, like a Microsoft and Apple?
Exactly right. Yeah. Exactly right. So, a lot of the kind of, I guess you can call them tech stalwarts that you would really think about are in that low vol group. It's also a lot of bigger companies in that low vol group. So like you said, Apple, Microsoft, things like IBM, Texas Instruments, Cisco, that's all in the low vol group. Again, those are bigger companies, so that's why it has an outsized impact on the index, because that's market cap weighted index. For the high vol group, it's kind of like those upstart tech names. So things like MongoDB, Palantir, Datadog, Snowflake, those make up the high vol tech group.
All right, Chris Kane here with our Factor Friday over at Bloomberg Intelligence. A great look here, I think, at the tech sector. A tech sector, I think, is really befuddling a lot of people, given some of the moves higher. We should point out that next week isn't going to be all about tech. We get a lot of earnings out of the retailers as well. That includes Walmart and Home Depot, which are going to kick off those retail earnings on Tuesday. Daniela Bretthauer joining us right now, America's retail analyst over at HSBC. And Daniela, I am curious, when we talk about the retailers as a group here, there's been so much talk about maybe a potential softness in consumer spending, and I know that's a very broad umbrella here, but is this something that we should be on alert to hear from these companies next week?
No, I don't think so. And good afternoon, everyone. Thanks for having us. The January retail sales that came out yesterday, obviously they couldn't compete with the strong holiday sales, but they were quite strong. You have extreme weather conditions throughout the country, which may also have played a role into the January sales performance, but people are still willing to indulge in categories like health and personal care and services like dining out. Spending at bars and restaurants are booming. They rose mid-single digits in the January retail sales. So we see that consumer confidence is still soaring. If you look at the University of Michigan data, that was quite strong. And so we do have Walmart, the biggest retailer in America, reporting on Tuesday, together with Home Depot.
So let's start with Walmart then. I mean, what are your expectations coming out of that report for a company that has made it clear that it has been a beneficiary of a lot of folks trading down? It's also been a beneficiary here of just the general economic backdrop.
Yeah, so we think that the consumer story is likely to hold up in 2024. Obviously, the retail stocks also tend to move with the interest rate cuts and the trends. So we saw in the January 31st report that, they're getting closer to cutting interest rates, but they will not do so until they have complete confidence that the inflation is moving towards the target. So inflation and consumer prices also play a very big role in retail.
Yeah, that's definitely been the case. And I think about companies like Target, which are trying to really capitalize on consumers' needs to search for the lowest prices. Target this week said it is launching a low price, its own brand for almost 400 everyday basics, anything below $1 to just under $10. So it sounds like Target is launching kind of its own internal dollar store. What do you think the prospects are for something like this?
So, yeah, to your point, high inflation has prompted U.S. consumers to favor value and to stay on budget. So companies with strong value prop, such as Walmart, Costco, and Target now, which reinforce its value proposition with this new private label offer, will generate savings for U.S. consumers. And therefore, we think that they are likely to do very well. So for Target, Target is in an important turnaround momentum.
Yeah.
So any new strategy that they can get to work well, it can make the stock run even higher. It has gone up 30% in the last month or so.
That's a story that's specific, particular to Target. I just wonder, when you look at the retail sector overall, the last few quarters, the theme, the focus was certainly about inventory management, both selection and volume. Is that still the focus, or have investors shifted their attention to something else?
Well, deflation risk remains the biggest elephant in the room going into 2024. So it can be quite positive for consumers to have deflation. But for the retailers, that means, exactly to your point, that they will have to sell even more, so higher volumes. But what if they cannot get the higher volumes to compensate for the lower prices? So we're watching very carefully any sort of risk of deflation. At this point, we do not see that. But like I said, it's the biggest risk to the investment thesis in the retail stocks.
All right. And we did get hints of that in the last couple of quarters from Walmart as well. Daniela Bretthauer of HSBC, thank you so much for joining us today.
Thanks.
All right. Coming up, the top three, where we focus in on the top three movers and shakers at the center of the day's biggest stories. This is The Close on Bloomberg. Time now for the top three. Every day at this time, we take a deep dive into the people at the center of the day's top stories. And first up is Alexei Navalny, the Russian lawyer and anti-corruption activist who became the most potent voice in opposition to Russian President Vladimir Putin. He has died. This is according to the maximum security prison camp in which Navalny was being held. He was 47 and remained worth noting that his death was announced on the eve of official campaigning for the presidential election in Russia, where Putin, of course, is seeking yet another term. Yeah, that election next month. And of course, one of his more vocal critics here, and really just a sad chapter here in Russia's relationship with the rest of the world. We do want to turn to somebody else who's been making news a lot over the last year, and that is Sam Altman, the OpenAI CEO, said to be seeking government approval for this massive venture to boost this manufacturing for artificial intelligence. Remember, he made a splash last week when he said that basically he would like to build his own chip fab here in the U.S. He thinks that he could maybe need $7 trillion to do that, to bring it up to speed. And now we're learning that as he's shopping around this idea, he's basically saying, letting those investors know that government giving him a green light, the U.S. government giving him a green light, is really going to be key to doing this. It's another way of getting everyone else to kind of do some lobbying on his behalf, isn't it? Yeah, and I mean, look, it's kind of a no-brainer here. He's not going to get $7 trillion, but he's going to get a lot of money out of this. Yeah, I'm sure he has lots of people lining up to help him out. All right, the third person we're watching is David Solomon. Goldman Sachs is boosting its CEO's pay by 24%. What's interesting here is this is after profit for the company slipped or fell by 24% for the year. It is fascinating, too, when you consider, remember when Brian Moynihan's pay came out, they cut it by 3%, and that was because profit also fell around that amount.
All right, interesting story there. I do want to get to some breaking news. We're speaking of Goldman, some breaking news on JP Morgan right now, and this involves that investigation to its trade reporting lapses. We're now learning that the company has agreed to pay about $350 million for those trade reporting lapses. This is based on a resolution that it has with 2 U.S. regulators, and it's in advanced talks right now with the 3rd U.S. regulator as well. This coming in a 10-K filing, a $350 million settlement for trade reporting lapses. That number could go up as it still has to negotiate with a 3rd regulator. We're going to get you some more details on that, and we will bring you those details as soon as we get them. But when we get back from the break, we do want to take some time to, wish a happy birthday to the legendary investor, Carl Icahn. We're going to take a look back on this day in history. We're going to take a look back at his legacy, and we'll leave you a question before we go to commercial. Scarlett, which movie character is presumed to have been modeled after Carl Icahn?
Gordon Gekko?
All right, well, we're going to give you the answer when we come back after the break. This is The Close on Bloomberg. On this day, here in 2024, we look back to 1936 and the birth of Carl Icahn, the man who put the activism in investing, a financial pugilist who sparred with the boards of Apple, Marvel, Texaco, Netflix, U.S. Steel, and dozens of others. His hard-nosed and once novel approach to investing, it involved zeroing in on a company, then gaining control, and then strategically selling off assets one by one. While Icahn, as a young man, had dreams of being a doctor, a detour into the U.S. Army, and a hot hand in poker led him to Wall Street. First as a stockbroker for Dreyfus in the early 60s, and soon for himself, running a risk arbitrage and options trading shop. That business quickly morphed into M&A when in the late 1970s, Icahn took a controlling stake in the appliance maker Tappan and forced a sale to Electrolux. It was a strategy he would rinse and repeat for the next 5 decades and counting. In the 80s, he forced B.F. Goodrich to pay a 25% premium on his shares just to stop him from buying more. In 1997, he pressured RJR Nabisco to separate its tobacco and food units. In 2007, he boosted his stake in BEA Systems just a few months before Oracle announced its acquisition of the company. Great timing. And in 2014, Icahn pushed eBay to complete the spinoff of PayPal. He's also had some colossal missteps, of course, including that mess he made of TWA back in the 80s and 90s. But Icahn's approach was winner take all, the epitome of Wall Street ruthlessness. So much so that movie director Oliver Stone was said to have fashioned the character Gordon Gekko after Icahn. Gekko even steals one of his lines: "If you want a friend, get a dog." A 2022 HBO documentary titled The Restless Billionaire characterized Icahn as terrifying, with oil tycoon T. Boone Pickens quipping that Icahn was as smooth as a stucco bathtub. And indeed, for all his success, Icahn made a lot of enemies, a lot, including a very public feud with Bill Ackman and just last year with short seller Hindenburg Research. But his approach to investing, it paid off big time, at one point amassing $20 billion in personal wealth, according to the Bloomberg Billionaires Index. And while that number has come down to $6.6 billion today, that still makes him among the 400 richest people in the world. And at age 88, Icahn is still going. The 13F filings released just this week, it showed new holdings in American Electric Power and JetBlue, the first publicly announced position since that Hindenburg report. And just in the last hour, we gotten a report that he's near a deal to get 2 seats on JetBlue's board. He's already got 2 on American Power. And that's a big reason why Carl Icahn still remains an icon today.
Well said. Very little slowing down Carl Icahn. And of course, we'll continue to keep you posted on developments in the companies that he does invest in. Now, investing and entrepreneurship do mark the highlight of our weekly Next Up segment. And today we want to focus on how people are using artificial intelligence to find love. A recent study found that 23% of singles are open to using AI chatbots for help. About 6% have already dabbled with AI in their dating lives, mostly to zhuzh up their online profiles. It's exactly the type of user base that apps like Volar cater to. After a unique onboarding process, Volar creates the ultimate AI wingman for users, which then goes on dates with other AI assistants. Joining us now from LA is Ben Chang. He is CEO of Volar. Ben, can you explain to us exactly how this works? How does your AI chatbot go on a date with another person's AI chatbot?
Yeah, it starts with the onboarding process where we have you talk to a natural language assistant who you can think of as kind of your wingman, wingwoman, or a matchmaker. They ask you questions about how you would introduce yourself and what you're looking for in a partner. Through that conversational process, the AI tries to learn not only your preferences and facts about you, but it also tries to understand your personality, how you speak. Are you casual? Are you formal? Do you make a lot of jokes? Do you make a lot of typos or use a lot of emojis when you talk? And through that process, it creates an AI version of you that then goes on dates with other people's AIs.
So it sounds like you're basically outsourcing the awkward first conversations to a chatbot rather than wasting the time on it yourself. I'm curious, when you look at the world of dating apps, what was the last big innovation in dating apps? Was it swipe right?
Yeah, I think the biggest innovation was around Tinder, right? So the iPhone just came out. People didn't really have photos at the time. When the iPhone came out, it was a perfect time for people to start to take selfies, learn how to take selfies, and the swiping mechanic has been amazing. It's super fast to kind of go through many different profiles. But since then, we feel like there hasn't been that many new innovations. And so that's why we thought this latest generation of AI technology with generative AI, LLMs, ChatGPT could be a catalyst for something new in the dating industry.
How long do I keep this AI wingman, Ben? Let's say my AI wingman hooks up with someone else's AI wingwoman. We hit it off. Do the AI bots just run off themselves and have a nice life together, or can I sort of rely on them maybe down the road when I'm having those complicated relationships with my significant other?
That's a good question. The way that we have it right now is the AIs only go on dates for the initial about 10 chat exchanges, and then they hand it off to the human to either take over or not if you feel like it's not a good fit. And so there's a very clear demarcation, and we'll see it visually in the app, where there's AIs talking to AIs, and after that, it's really on you to build a human connection. So for now, it's still up to you to try to find your partner and your connection.
Yeah, well, thankfully, I've already found her, and I love her to death. Ben, I am curious, though, for those folks, though, who are still searching, this gets to a question, too. Like, what type of response have you gotten from, I guess, existing users, but more importantly, potential users? Because when I see this, I mean, there's going to be a lot of people that are going to bristle at this whole idea and say, oh, this is nonsense here. I would think, though, there's also a certain group of people out there that look at this and think this is like the coolest thing since sliced bread.
Yeah, so I think it kind of depends on whom you ask. Of course, there are people who say, I don't think that AIs can help you build a real human connection. And I agree that it can't replace humans, but I do think it can automate, as you said, the initial awkward icebreaker stages. But what we've heard from users is that this does filter for people who are a little bit more serious, because it takes a little bit more time to talk to the chatbot to give it your preferences. And also, when you look at profiles, you probably have to read a little bit of the exchange, which is a little bit more work than swiping photos. So some of our users have said that they actually really appreciate that. It actually does kind of filter out some of the more casual users who, Tinder works pretty well for hookups and swiping left and right. So we've heard that.
Right.
And another thing is users say a lot of things, but you can tell by their behavior what happens. And users keep coming back to Volar, which we think is kind of the biggest endorsement for Volar working for them.
Ben, I noticed that you used to be a product developer for the My AI chatbot over at Snap.
That's right.
What surprised you the most about how teenagers and young people interact with chatbots and use that feature that informs how we might all eventually use AI chatbots?
Yeah, like we learned a lot of things from the My AI experiment. One of the things that's maybe most obvious is a lot of hallucinations happen with these GPTs and LLMs, which refers to making up facts that aren't true. And that is an issue, right? And that's where this generation of technology, at least so far, is not very good at things where it needs to be very, very accurate, like information retrieval, facts about health, science, general facts. It's probably better to use Google or something else for that at this point. But we did find that hallucinations actually are good for sparking creativity and things that maybe you would not expect. And so that's where something where it's a little bit lower stakes, like dating, where I'm not going to make a huge mistake where I'm telling you, some like medical diagnosis that is inaccurate.
Right.
The hallucinations are actually like a point of conversation where you can try to find a connection with the other people.
Lower stakes in this case. Ben, really appreciate your joining us today. Ben Chang is CEO of Volar. Good luck to you. All right, let's, when I think about I really love that imagery of the chatbots running off, because that was kind of my question too. At some point, you might want to call back the chatbot and be like, I really need you to,
Yeah, if you believe in a dystopian
deliver
future,
this message that I can't do it myself.
Yeah, and it doesn't help that I just watched this great movie. It was called The Creator with John David Washington. It's all about AI robots and how they basically become sentient and then start procreating on their own. And that's all I could think about as I was talking to him. I know that's not what he's going to do.
Right.
But it does raise the question here as to how much control we give this type of technology over our lives. In this case, obviously, it could be very helpful, but you kind of wonder how far that goes.
Yeah, and how long that data stays with that chatbot. They know all of these things about you, even if it is kind of silly information.
Yeah.
All right, let's move on to how markets closed on the day. Actually, for the week, what was interesting, Romain, is that the S&P 500 snapped its streak of 5 weekly gains.
Yeah.
First weekly decline since early January.
Yeah, still holding, though, that 5,000 level for those people that like big round numbers. But this was kind of overdue, right? And you talk about just how far this rally had come. And it's not to say the rally wasn't justified, but any healthy rally needs a pullback.
Absolutely. And of course, we're going to get an opportunity to see if the rally has another leg going forward, because NVIDIA will report earnings next week. So that'll be a key focal point. 10-year yield inching higher by 4 basis points. And of course, the dollar, little change on the day, but with...
Now, there's your rally.
Exactly,
exactly. Yeah.
It's been a wild week with that hotter than expected CPI and PPI report. Crude oil moving up by 1 2/3%. This is the close on Bloomberg.
All right, there's a great new Bloomberg original show out there. It's called An Optimist's Guide to the Planet. And this week we focus on a company that is transforming the construction industry towards a more sustainable economy. Take a look.
So basically this was a former brewery. And so this is where this opportunity was like, okay, let's do something with that building. So everything you see was on another building. For example, here, there's nothing glued. Everything is screwed or stacked. So that means basically you can, if you want, unscrew everything and put it somewhere else. Yeah. This is also quite interesting because this basically was at the camping place before. Okay. The pipes, right? They are not hidden. Normally in a building you hide this in the wall, but now it's easy. But because you cannot get them out anymore, so you just have it here. And it looks actually quite nice, and so it's easy to change it. It's easy to deconstruct it also again. Yeah. We have these grids. These were normally put on the bottom, right? Yeah. They're like now used as a banister. Yeah, exactly. Look at the windows. In Germany, you have to have double glazed windows. We just put 2 windows. With this, we can fulfill all the regulations. Sure. Also, quite interesting material here. So maybe you recognize that this is something we use normally for construction sites, right? Yes. And now this is the handle for going up the stairs.
A great show there with Nikolai Coster-Waldau from Game of Thrones and the man he was talking to, Dominic Campanella. Joining us now from Berlin. He is the CEO and co-founder of Concular. Great to have you here on the program. A real fascinating look here, not just on what you do, but really just the possibilities for us in terms of humanity, if you will. And I just want you to start out, if you could kind of contextualize this for us, because I was interviewing someone a couple weeks ago who had a sort of a recycled concrete company, and he said that concrete or cement or something was like the most polluted material out there right now. Is that true?
Yes, good evening from Berlin, actually from the building, which you just saw. And yeah, basically, it's true. The construction sector is the largest polluter in the world, and by far. So 60% of all waste which we generate is coming from that sector, and 40% of all CO2 emissions are from this sector. And what's really interesting is when you look at the numbers, you can see that half of these emissions, so 20% of the global emissions, are due to the production of construction materials. You're only looking at concrete. If you would look at the concrete production as a country, it would be the third biggest polluter in the world after the US and China. So there's a lot of opportunity right now to really solve an issue. And I'm always saying, like, climate change is in the end decided on the construction side.
It's interesting because your company is sort of described as circular in nature. And I thought this was one of the fascinating things in the documentary, because when we think of when houses sort of get torn down, we've all watched HGTV. It's like everything just gets destroyed and thrown into the trash heap. You're saying there is a way to preserve a lot of those materials and reuse them.
Exactly. I mean, these are really highly valuable materials. So what is normally happening right now is like we take materials or like resources out of Earth, we produce like really high quality materials, we put them into buildings, and sometimes after just a couple of years, we take this really high quality materials, and what are we doing with them? We are landfilling them. So right now, only 1% of all materials are getting reused. And yeah, this is what we, of course, want to change with Concula here in Germany. What we do is we go into buildings, we digitize all the materials in these buildings, and before deconstruction is happening, we take these materials and we match it with the demand of new buildings, and basically take these materials out and can shift like this 1% up to 70 to 80% of materials which we can get into the material cycle again, which of course like is a lot and has a huge impact.
Right, right. No, so your goal is to reuse that material rather than even recycle it, and of course, the worst case scenario, just dispose of it entirely. Talk a little bit about the ways that you make sure that you can preserve that material. We showed a clip earlier where you were talking about how material should be screwed in rather than using glue to put it in place. Why is that important?
Yeah, there's actually two big issues right now if you want to reuse materials. So one issue is pollutants. Unfortunately, we put a lot of pollutants into our materials in the past. Of course, this is not a problem anymore that much nowadays, but basically the buildings we are deconstructing right now are the buildings which were built like 40, 50 years ago. But the second issue is that like 80 years ago, so we did glue everything, but now we really glue them. And if you glue something, I mean, just glue two papers, you don't get them out anymore, right? But you don't need this complete component, you need the two components, and this is not possible anymore. And this is then waste, and waste is not something which is really good.
Yeah, well, thank you for explaining that. That helps a lot. Clearly, what you're doing is mission-driven, and you are fairly niche at the same time. What's your plan to scale the reuse of construction materials?
Yeah, basically, as said, like to really reduce CO2 in the construction sector, you really have to think about reusing, recycling construction materials. So there's a potential of about saving 13% of the global CO2 emissions if we really look at every building before deconstruction and look how can you reuse and recycle them. And how we want to reach that is to make that required. So in Germany, 20,000 buildings are right now getting destroyed every year. And there's no requirement to look at if there are materials which you can reuse or recycle. So we created a standard, and now this is implemented into law that you cannot tear down any building anymore without looking if you can reuse or recycle these materials.
Where's the market for this right now, Dominic? Is it primarily in Europe? Does it spread?
Basically, this is where buildings are built. So everywhere in the world, there's, of course, the market. And what you can actually see is like countries, there are some countries which are seeing the value in materials already. Look into India or something like that. If there's a building getting deconstructed, they are already taking the materials because these materials have a high value. But especially in countries where there's a really, really high economy, such as Germany or the US, these materials are normally not considered as valuable, and these are the markets we want to go in. Because basically what we do is we create out of a cost block, so paying for the landfilling of the materials, a value block, because now you get money for selling the materials. So we basically create value out of it.
All right, Dominic, this is a really fascinating. You're doing some real cool stuff and really important stuff. Dominic Campanella, CEO and co-founder over at Concular, a circular construction company, basically a big focus on recycling. And that's part of a great docuseries out there right now called An Optimist's Guide to the Planet. You can tune into that. Catch it on Bloomberg.com, on the Bloomberg app, or right here on Bloomberg Television. All right, stick with us. We're going to set you up for what could be a really busy week next week as well. That's coming up after the break, right here on Bloomberg. One of the big market catalysts next week could be NVIDIA earnings coming on Wednesday. Nick Turner joining us right now from our San Francisco bureau. And Nick, I was just taking a look at some of those revenue growth numbers here. We're tracking it like 200% higher than where we were the previous quarter here. You expect that to be sustainable?
I mean, for a little while at least, it is pretty insane for a company its size. You just don't see these kind of revenue growth numbers, in the 200 range for, I think, last quarter, this quarter, the next quarter. Eventually, obviously, it does come down a little bit. But you're talking about a company that's going to have $20 billion in revenue this quarter that they're about to report, and that's twice their annual revenue from 2020. I mean, it's just really hard to wrap your head around it.
Yeah.
Absolutely. And you look at how the stock has performed, up 230% over the last 12 months, up 45% since the last earnings report. How high is the bar? I mean, what's a beat here? Is there a whisper number that we need to watch for?
I mean, people have been moving their targets up, so it's not like a situation where these things have just been kind of frozen and people aren't increasing their expectations. So I don't know. I think it's going to be hard. With the market valuation is 1.8 trillion. It's up not just 230% in the past year, but I think 45% this year alone, just in a couple months. So yeah, I mean, I think it's probably going to be hard to, really surprise people on the upside, given that you're coming in on that.
All right. Well, it's going to be quite a day next Wednesday. Nick, we're going to let you go here. Nick Turner in our San Francisco bureau. NVIDIA earnings on tap for next week. A very busy week. It's going to be a holiday shortened week. So let's set you up with those big events here. Of course, Monday, a holiday here in the U.S. as we celebrate our presidents.
President's Day,
and
right?
we know we
Plural
love our
now.
presidents.
Yes.
Yeah.
But we look ahead, of course, because it's going to set the tone, all these earnings reports, whether it's from NVIDIA, which we'll talk about, of course, and retail.
Yeah.
You get the start of retail earnings season. Walmart will be reporting.
Yeah, that's on Tuesday. Again, quite a few others. Home Depot as well here. So we'll get a little bit of a read on consumer spending, how well that's holding up. And then, of course, you see there, and others too. I mean, Etsy could be a big one as well here. So I think a lot of people really want to see sort of where the money is going and where it's not.
Yeah, well, Warner Brothers Discovery, we know that cost cutting is going to be a big, big theme for all those streaming companies.
Yeah.
And let's not get too far away from macro because Fed minutes come out as well from the last Fed meeting.
Yeah, we are going to get those FOMC minutes also on Wednesday. Oh, that's prior to NVIDIA's earnings. It'll be interesting to see whether there was any real discussion at that meeting about what everybody wants to know, which is when they're going to cut rates. But I don't know, after the data we got this week, I feel like those Fed minutes are kind of obsolete right now.
It feels like it, especially with Larry Summers, the former Treasury Secretary, saying you now need to consider the possibility of a rate increase following the hotter than expected PPI report and CPI report.
Yeah, that would have sounded implausible just a couple of weeks ago, but certainly, definitely a possibility. And we're actually going to hear from a lot of those Fed members too, so maybe we do get some insights. Raphael Bostic, Lisa Cook, and Neil Kashkari scheduled to speak. Who you got?
I always pay attention, of course, to your favorite Fed official, which is Bostic. But Kashkari is always entertaining, if nothing else.
All right. A holiday shortened week, but still a busy one. Please tune in. We'll have full market coverage for you right here on The Close. In the meantime, if you're into politics, we got a lot of coverage coming up here at the top of the hour. Balance of Power coming up next, right here on Bloomberg.